Imagine running a company where you hold like a literal monopoly on the most important technology on Earth.
Right, which is already hard to fathom.
Yeah, and you are printing over $115 billion in pure net income. I mean, your profit margins are practically illegal.
They certainly look that way on paper.
Exactly. And almost every single analyst on Wall Street is screaming at the top of their lungs that your stock is a strong buy. So, why are the people who actually run the company quietly rushing for the exits?
That is the big question right now.
It is. Welcome to the deep dive. Today, we are taking a snapshot of Nvidia as of April 2026. We are tearing into the financials, the underlying technical battleground, and that stark, honestly fascinating contrast between what Wall Street is saying out loud and what the smart money is actually doing in the shadows.
It really is the ultimate trillion-dollar mystery of the moment.
Yeah.
Because on the surface, the narrative seems impenetrable, right?
Right. Totally solid.
But beneath that surface, there is this incredibly fierce tug of war happening. You've got these massive structural fundamentals clashing with real-time market mechanics. It's basically retail enthusiasm going head-to-head with institutional algorithmic selling.
Which is exactly the conflict we are going to untangle for you today. But real quick, before we break down this mystery, if you are finding value in these breakdowns, do us a huge favor. Hit that subscribe button on your audio feed, and please leave us a comment with your feedback wherever you are listening.
It really is the best way to help us keep doing this.
It absolutely is. Okay, so getting into this snapshot. The macro environment surrounding the stock is tense. We just saw a massive tech rally triggered by the news of a U.S.-Iran ceasefire.
Yeah, that was a huge catalyst.
Now, to be absolutely clear up front, we are analyzing that strictly as a market catalyst. We do not take political sides on this show. But, you cannot ignore how a global ceasefire injects a massive wave of relief volume right into the tech sector.
Well, yeah, but that relief volume is really just a temporary sugar high.
A sugar high.
Yeah, I mean, the ceasefire news provided a macroeconomic shock to the upside, sure. But it doesn't change the underlying structural reality of the company's balance sheet. And that balance sheet is what actually dictates long-term price action.
Okay, so to understand the current stalemate, we have to establish just how massive this company has become.
Right.
I am looking at their fiscal year 2026 wrap-up here, and honestly, the numbers look like a typo.
They usually do with this stock.
Right. They pulled in a staggering $215.9 billion in revenue. That is up 65% year over year. How does a company this massive keep accelerating like a Silicon Valley startup?
Because the sheer velocity of their capital generation, it just defies historical precedent.
Yeah.
We're talking about $153.5 billion in gross profit.
Wow.
Yeah, which translates to a 71.1% operating margin.
71%.
Exactly. Historically, when you build hardware, margins compress over time, right? Because competition scales up, they undercut your prices. But Nvidia has somehow managed to do the exact opposite.
Because they've effectively monopolized the absolute premium tier of the market.
Precisely.
It's not just that they are selling pickaxes during an AI gold rush. It's that they're the only hardware store in town, and they are charging a 70% markup on every single shovel they sell.
That's a perfect way to look at it.
And look at the balance sheet. They are sitting on over $10.6 billion in cash. Their debt to equity is almost non-existent at 7.26%. And they just returned over $41 billion to shareholders through buybacks and dividends.
Which is key, because those buybacks act as an artificial floor for the stock.
How so?
Well, when a company buys its own shares, it reduces the overall supply in the open market. So that naturally increases the value of the remaining shares. But here's the catch. The market is forward-looking. Everything you just listed, the revenue, the margins, the buybacks, that is the baseline expectation now. It's the new normal. The market has already priced in the fact that this company is building the physical railroads for the next technological epoch.
Which totally explains the wild volatility we've seen. Looking at our April 10th snapshot, the stock is hovering right around $188. It got a modest 2.5% daily bump off that ceasefire news, and it's up about 6.3% on the week.
Yeah, a decent little rally.
But the 52-week range is what really catches my eye. We are talking about a low of $95 back in April of 2025, ripping all the way up to a blistering high of $212 last October.
It's a massive spread.
It's wild. A swing like that makes sense for a risky mid-cap growth stock, but for a multi-trillion-dollar behemoth, it's just crazy. And this wild swing leads directly to the core debate surrounding this stock right now, which is this valuation paradox.
Yeah, the valuation is where the cognitive dissonance really sets in for a lot of investors.
Because if you look at the traditional metrics, the stock actually appears to be heavily discounted.
Exactly.
The undervalued argument is plastered all over our sources. The blended price to earnings, or PE ratio, is currently sitting at 38.2. Now, if you track the tech sector, you know that a 38 PE for a hypergrowth tech giant is surprisingly cheap.
Very cheap, especially when you consider Nvidia's 5-year median is up in the 60s.
Right. Guru Focus even calculates their fair value up around $307, which implies the stock is currently 38% undervalued.
And Wall Street is eating that up.
Oh, they are fully buying into this. Out of the major analysts tracked, 93% are saying buy. We have 47 analysts screaming strong buy, 2 saying hold, and exactly 1 lone wolf saying sell.
Always one.
Always one. The average 12-month target is $268. That is a massive 42% upside from where it sits today.
But we need to dissect the mechanics of that 38 PE ratio because it is a classic earnings catch-up scenario.
Okay, break that down for me.
So for a long time, the stock price was skyrocketing into the 200s, but the actual finalized earnings hadn't reeled in yet.
Got it.
So the PE was astronomical. Now the company is finally officially logging that $115 billion in net income. The E in the PE ratio has just exploded.
So even though the stock price is still high, the multiple comes crashing down.
Exactly. To a fundamental analyst sitting at a desk in Manhattan, a 38 multiple for a company growing revenue at 65% year over year is, it's practically begging to be bought.
Right, and if you are listening to this and holding Nvidia in your retirement account, that low PE and those 47 strong buy ratings probably look like massive green flags.
Yes, they do.
But my experience tells me that when Wall Street consensus is screaming that a stock is a cheap, guaranteed 40% upside, retail traders usually end up buying the top and holding the bag. Is this a trap? If the fundamentals are this flawless, why did it need a macro event like a ceasefire just to get a 2.5% bump?
Which brings us to the plot twist. You cannot just listen to what analysts say. You have to watch what the people with actual leverage are doing with their own capital.
Following money.
Exactly. The disparity between the public narrative and the private capital flow is the literal definition of a value trap.
And the sources show a brutal reality when you follow that money. The insiders, the people who actually work there, the ones who see the supply chain and the upcoming order books, they are taking massive profit.
Huge profits.
In March of 2026 alone, there were 25 separate insider transactions unloading over $27 million worth of stock.
And that's just the everyday insiders.
Right, because that is a drop in the bucket compared to Director Mark Stevens. He separately dumped $38.5 million worth of shares on a single day, March 24th, at $173 a share.
Now look, insiders sell for a variety of benign reasons, right? They pay taxes, they buy real estate, they diversify their holdings.
Sure, normal wealthy people stuff.
Right. But the sheer density of selling at these specific price levels is a flashing warning sign. They are effectively saying that the current price adequately reflects the company's near-term peak value.
Wow.
But the insider selling isn't even the most concerning metric here.
You are talking about the institutions.
Yes.
Our sources highlight a metric called Chaikin Money Flow, or CMF, which is currently sitting in the negative at negative 0.08. And hedge funds broadly sold tech stocks at the fastest pace in 13 years back in March.
Yeah, that's the big one.
Explain the mechanics of this for me. Why are the massive hedge funds quietly rushing for the exits while the analysts at the exact same firms are telling retail investors to buy?
Because that is the anatomy of a liquidity trap. See, institutions hold tens of millions of shares. They cannot just log into a brokerage app and hit sell all.
Right, they'd crash the market.
Exactly. If a whale dumps 10 million shares on a random Tuesday, they will instantly crash the price and destroy their own wealth. They require immense liquidity to exit their position safely.
So they need buyers.
Yes, they need a steady stream of enthusiastic buyers to absorb the shares they are quietly offloading.
Oh, I see. They need retail traders to believe the historically cheap PE narrative.
Yeah.
They need us to think it's a no-brainer so they have someone to hand their shares to.
That is exactly what the Chaikin money flow metric exposes.
Mm-hmm.
CMF doesn't just look at whether a stock went up or down. It looks at where the stock closes relative to its daily high-low range, factored against the total trading volume.
Okay, so what does that tell us?
If a stock opens high on a wave of good news, but routinely closes near its lows on massive volume, it means institutions spent the entire day methodically selling into that retail buying frenzy.
Sneaky.
Very. A negative 0.08 CMF is a classic footprint of institutional distribution. The smart money is actively sitting out this current rally.
So if the smart money is quietly handing off their shares to retail buyers, that completely explains why the stock is basically boxed in. It's a stalemate.
Yes, it is.
So who is actually winning that tug of war right now on the charts? Let's talk about the technical battleground.
Well, the current setup is neutrally to cautiously bullish in the very short term, but it is incredibly fragile.
Fragile how?
The stock is boxed in between two major structural moving averages. It's hovering right around the $180 mark, sandwiched between the 50-day SMA, which is at 179, and the 200-day, which is at 180.52.
And the 200-day is the big one, right?
Yeah, in technical analysis, the 200-day average is the ultimate psychological line in the sand. As long as it stays above that, the long-term trend is technically intact.
But the moving averages are lagging indicators. They tell us where the stock has been, not necessarily where the momentum is going.
Right.
The sources point to the MCD, the moving average convergence, divergence, which is flashing a literal sell signal. It's sitting at a negative 0.78, showing a bearish divergence.
Yeah, the RSI is kind of neutral at 56, but some platforms even have it hitting overbought up around 77.
Which is wild. But going back to that MACD, I love the analogy we've discussed before for this. Think of the stock price like a car driving up a steep hill, and the MACD is the gas pedal.
It's the best way to visualize it.
Yeah.
So the bearish divergence happens when the car is technically still moving higher up the hill, so the price is rising, but the driver is slowly lifting their foot off the gas pedal.
The momentum is fading.
Exactly. The underlying momentum is fading, and eventually gravity is going to win. That negative MACD reading tells us that this recent upward bounce doesn't have the heavy institutional volume behind it to sustain the climb.
The car is about to stall out.
The car is stalling out.
Okay, so if the car is stalling, what are the literal lines in the sand we need to watch? Where are the guardrails, and where do we fall off the cliff?
On the upside, Nvidia faces a dense ceiling of resistance, roughly around $185.
Okay.
If it can break through that, there's some breathing room up to 190.53, and then upper resistance at 197.72.
And if it crosses that 197 mark?
If it manages to cross 197, a lot of this bearish pressure gets completely invalidated. The pattern breaks.
So the downside is where it gets precarious.
Yeah, the safety nets are incredibly thin.
Like how thin?
Very thin. If it snaps below that 179 support level, there is virtually no structural support until you hit 175. And below that is the critical, highly dangerous floor sitting at 161.35.
A highly dangerous floor at 161. That directly introduces the worst case scenario. Why is that specific $161 level so terrifying for the bulls? Like, what happens if the stock drops that far?
That level serves as the neckline for a looming head and shoulders pattern.
Ah, the classic head and shoulders.
Right. It is one of the most reliable bearish reversal patterns in all of technical analysis. It visually maps out buyer exhaustion.
So how does it form?
Buyers try to push the price to a new high, forming the first shoulder, but they fail. They try again with a massive push, forming the head, and fail again. Then they try one last, much weaker time, forming the right shoulder, and finally just give up.
And if the price breaks below that 161.35 neckline?
The structural math of the pattern dictates a measured downside drop all the way down to a target of $137.
A drop to 137. That would wipe out hundreds of billions of dollars in market cap.
Yes, it would be a bloodbath.
But technical patterns don't just execute in a vacuum. There has to be a real-world mechanism, a why, that forces institutional algorithms to dump the stock down to those levels.
Right, the catalyst.
And the sources point to some severe macroeconomic headwinds brewing that could be that catalyst.
Yeah, technicals just map human psychology, but the macro environment is what actually drives the decisions. First off, you have oil prices pushing above $111 a barrel.
Which is high.
Very high. And the mechanism here is direct. High oil prices increase global shipping and manufacturing costs. Those costs are passed to consumers, which creates sticky inflation.
And if inflation stays hot?
The Federal Reserve refuses to cut interest rates.
And high-growth tech stocks absolutely despise high interest rates.
They hate them. because it changes the risk-reward calculus for big money. If a hedge fund can get a guaranteed 5% return from government treasuries just because rates are high, they're far less likely to risk billions of dollars on a volatile tech stock. High rates systematically drain liquidity out of the stock market.
Makes total sense. The other massive headwind here is geopolitical. Nvidia is currently seeing zero revenue from China for their H200 chips due to ongoing export bans.
Zero revenue?
None. Now, again, I want to step in and strictly remind everyone listening that we are analyzing this impartially. We are not taking any political stances on U.S.-China trade policy or national security measures.
Of course not.
But strictly speaking, as a market force, losing the entire Chinese market for your flagship AI hardware, that is a catastrophic chunk of change to simply wipe off the ledger.
It creates a gaping hole in their total addressable market. When you combine sticky inflation, delayed rate cuts, and massive geopolitical export bans, you finally start to see why the institutions are quietly de-risking and heading for the exits.
Even while the retail traders are staring at a seemingly cheap PE ratio.
Exactly. The big money sees the macro storm clouds.
That is a brutally dark storm cloud. But let's be real here, Nvidia didn't reach a $215 billion revenue run rate by accident.
No, they certainly didn't.
They aren't just selling a consumer fad like fidget spinners. They are selling the physical compute power required for the next era of human technology. So to balance the scale here, we have to look at what snaps them out of this technical stalemate.
The bull case.
Exactly. Let's dig into the bull case and the long-term outlook. What upcoming catalyst could crush that bearish narrative?
Well, in the very short term, the ultimate catalyst is always earnings. Q1 fiscal year 2027 earnings are approaching rapidly on May 20, 2026.
Okay, mark your calendars for that one.
Yep. And the guidance for that single quarter is already set at an astonishing $78 billion in revenue.
$78 billion.
In one quarter.
That's insane.
To put that in perspective, they are generating more revenue in 3 months than many legacy Fortune 500 companies generate in a decade.
Wow.
So if they beat that $78 billion or offer even higher guidance for Q2, the sheer force of that capital could completely shatter that bearish head and shoulders pattern.
Just brute force it out of existence.
Exactly.
Looking a bit further out, the next massive growth leg is the highly anticipated Vera Rubin chip launch, which is scheduled for the second half of 2026. Right now, Nvidia holds an estimated 85 to 90% market share in AI GPUs.
They operate virtually as a monopoly.
They really do.
Yeah.
Competitors like AMD are making strides in hardware, sure, but Nvidia's true moat isn't just the physical silicon, it's the software.
Yes, the CUDA software ecosystem. It is the invisible chain that keeps developers locked into Nvidia's hardware.
How does that work exactly?
So CUDA is the programming platform used to build AI models on these chips. Once an entire generation of PhDs and software engineers learns to code their complex AI models on CUDA, they cannot easily port that code over to an AMD chip.
It's like trying to run an iOS app on an Android phone?
Sort of, but way more complex. The switching costs are astronomically high. That software moat protects their 70% hardware margins.
Got it. And if we zoom out to the truly long-term view, the ocean of money flowing into this sector is hard to fathom. Total AI capital expenditure across the industry is projected to hit $630 billion in 2026 alone.
It's massive.
Every major tech giant, Microsoft, Google, Meta, they are all forced into an arms race to build these massive server farms. And the sources project that this is just the foundation for a $3 to $4 trillion AI infrastructure market by 2030.
$4 trillion.
And Nvidia essentially owns the only toll bridge into that $4 trillion future.
Which really forces you to segment your timeline as an investor.
What do you mean?
Well, the short-term view, the next few weeks to months is going to be highly volatile, range-bound chop.
Right.
We're likely going to see the stock violently bounce between the 170s and 190s. That price action will be entirely dictated by the macro forces. What oil does, what inflation does, what the Fed says.
It's a trader's market right now.
Exactly.
Yeah.
But if you look at the medium to long-term horizon, assuming they maintain that software moat and the global AI rollout continues on pace, the structural outlook remains undeniably bullish.
So, synthesizing everything we've unpacked today for you, the listener, you are staring at a fascinating high-stakes tug-of-war.
Absolutely.
On one side, you have a company with flawless, record-breaking fundamentals, a near monopoly in a booming sector, and a surprisingly affordable PE ratio on paper.
The perfect bull case.
Right. But on the other side, that stock is locked in a cage match with fading technical momentum, severe macro headwinds from sticky inflation and export bans, and a massive, massive wave of insider and institutional selling.
It really is the ultimate test of an investor's conviction. You have to decide if you are trading the turbulent chart sitting in front of you today, or if you are investing in the infrastructure of the world you think will exist in 2030.
And before we wrap up, I need to explicitly state, as always, we are just breaking down the data, the charts, and the underlying sources for you. This is absolutely not financial advice.
Not at all.
We are simply here to help you understand the mechanics at play. What you decide to do with your own portfolio is entirely up to you and your financial advisor.
I will leave you with this final provocative thought to mull over, though.
Okay, let's hear it.
If the long-term projections are accurate, if artificial intelligence is truly heading toward a $4 trillion infrastructure market by the end of the decade, and Nvidia essentially has a monopoly on the hardware required to build it,
Right.
why did some of the smartest hedge funds in the world just dump tech at the fastest pace in 13 years, right before the revolutionary new Vera Rubin chip drops? What does the institutional money know that the charts just aren't telling us yet?